In this learning, we are computing free cash flow to the firm from net income. We have to have income statement with us and a few other pieces of information as well. So maybe we also would need balance sheet and statement of working capital to have all sort of information that is needed here. So in this scenario, we have income statement and balance sheet and also working capital statement for this business for whom we are trying to calculate free cash flow to the firm. So this formula is given here, and of course the starting point is net income, and this information would be available mostly from income statement to us. So when we are calculating free cash flow to the firm, and we are starting with net income, the first thing that we have to add is net non-cash charges, right? So these non-cash charges already are deducted from net income, right, in the income statement, but they did not result in any sort of cash flow, so these are added back here. And the most prominent non-cash charge is of course depreciation. And then we have to add interest into 1 minus tax. Why we are adding it back? Because in income statement, interest net of taxes have already been deducted, but at this moment, remember what we are calculating. We are calculating free cash flow to the firm. So when we are talking of firm, we are talking of both the suppliers of capital, debt as well as equity. So this cash flow is available both to debt and equity holders. So, but this interest has already been deducted. And when we are talking of computing free cash flow for the firm, then it has to be added back, because this is the cash which is available both to debt as well as equity holders. So this item, interest net of taxes, has already been deducted in the income statement, so we add it back here. And then there is a deduction for investment in fixed capital. Company might have purchased some plant, property and equipment items, and that money invested in there would be deducted here because it was outflow of cash, and similarly investment in working capital would also be deducted here. But it has to be understood here that when we define working capital, normally we say, okay, working capital is current assets minus current liabilities. But when we are talking in terms of valuation, or when we are talking of cash flow for valuation purposes, at that time working capital is actually current assets minus current liability. Yes, but here we exclude cash from the current assets as well as cash equivalents, I should say. From liabilities we exclude short-term debts like notes payable and current portion of long-term debt. So these items are excluded while calculating working capital for the purposes of valuation. So essentially current assets would be what? Essentially current assets would be now accounts receivable as well as inventory, and in current liability we will be mostly dealing with accounts payable, because we have excluded from current assets cash and cash equivalents, and from liability things like notes payable. So if we pay attention, it also shows that, okay, we are not deducting preferred dividend at this point of time. So we are assuming that there is no preferred dividend paid by this firm. But if there is some preferred dividend, then definitely that would also be excluded here. The way we excluded interest expense, same way we will exclude the preferred dividend as well, if there is some information about this fact in the corporate information. Okay, in order to understand the calculation part of it, let us go through this scenario for this company gain distribution, where we have the information and we have got income statement, balance sheet as well as working capital schedule here. So let us start with the net income. So net income, this number net income, this would be available from income statement, and this number is actually 97.52. We will store this number 97 0.52 in our calculator stored in first memory spot, and this is also entered here in the formula 97.52. Then we need non-cash charges, which is mostly depreciation, and it would be added back. This information is also available to us from income statement. Depreciation is 45, and this is entered in second memory spot in the calculator. Entered means stored in the second memory spot. Third piece of information that we need is interest expenses times 1 minus tax rate. Interest expense is also available to us in the income statement, so which is 15.68 times 1 minus tax rate. So in this scenario, tax rate is given to us and it is 30%. So we have to do this number times 0.70, so that is the number 10.98, and this number we will store in third memory spot. And then in this formula we need fourth piece of information, which is investment in fixed capital. In balance sheet we should see that over the 2 years in consideration there is no additional investment in fixed assets, so change in fixed assets is 0, so no investment has been made, so this number would be 0 number. So we will enter this number as 0 in the fourth memory slot here, 0 store in fourth memory slot. And then fifth number that we need is investment in working capital, and here it is given that over the period investment in working capital has increased by 56, so we will enter this number in the fifth memory spot. So we got all these numbers now. Let us now calculate free cash flow to the firm from net income. So we will recall one number, which is net income, of course, 97.52, which we got from income statement, and then there will be addition to that, non-cash charges add to that. So we will recall second memory spot. So we will recall second memory spot, which is 45. So this is non-cash charges and this would be addition. And third is interest into 1 minus tax, which is in third memory spot, 10.98. Investment in fixed capital was 0, that is minus 0. Then investment in working capital was 56. That would be minus here. Let us do these numbers now. Recall 1 plus recall 2 plus recall 3 minus recall 4 minus recall 5, which gives us 97.50, and this number is also given here. So this is free cash flow to the firm, which is being computed from net income. So this way we will calculate free cash flow to the firm for all the years in the consideration, and after that these are discounted. These free cash flows are discounted at weighted average cost of capital to compute value of the firm. This we will learn in upcoming learnings.